Hi everyone, I hope you are ready for another tax study session. I'm going to be your virtual companion in studying the concept of income, which is also part of the coverage of our exams. Before we start, here is our student's guide to learning from home. Set up your study space. Find an area in your house where you can sit comfortably and focus. Make it separate to your relaxation space, ideally away from a TV screen or other distractions. Take down notes. Stuck in a webinar zoning out? Taking down notes keeps your mind engaged. Plan your day ahead. If you have one, follow the schedule provided by your school. If you just have a list of things to study, break it down into small tasks and plan to do the hardest ones when you have the most energy. Lesson distractions. Harness your imagination and picture that you're at school and not at home. Lock your phone away if you need to. Don't be afraid to ask your parents to intervene. Subscribe to productivity apps as well. These are great study companions so you can focus 100%. Change it up. You probably have a schedule for your lessons, but if things are becoming difficult to focus on, take a 5-minute break and come back to it. Just let your teachers know. Be kind to your mind if you need a break from a consistent schedule. Now, let's get down to business. What is income? In the broad sense, it means all wealth that flows into the taxpayer other than as a mere return of capital. It includes the forms of income specifically described as gains and profits, including gains derived from the sale or other disposition of capital assets. Income means cash received or its equivalent. It is the amount of money coming to a person or corporation within a specified time, whether as payment for services, interests, or profit from investment. It is distinct from principal or capital. The distinction between capital and income is well settled in our jurisprudence, as held in the early case of Madrigal versus Rafferty. The essential difference between capital and income is that capital is a fund, income is a flow. A fund of property existing at an instant of time is called capital. A flow of services rendered by that capital, by the payment of money from it, or any other benefit rendered by a fund of capital in relation to such fund through a period of time, is called an income. Capital is wealth, while income is the service of wealth. The Supreme Court of Georgia expresses the thought in the following figurative language. The fact is that property is a tree. Income is a fruit. Labor is a tree. Income, the fruit. Capital is a tree. Income, the fruit. Now, assuming you will withdraw money from your savings account, can it be considered as an income? The answer is no, because income is other than a mere return of capital. How about income held in trust for another? As a general rule, income held in trust for another is not taxable since the trustee has no free disposal of the amount thereof, except if the income under trust may be disposed of by the trustee without limitation or restriction. Now, when do we consider income as taxable? The following are important considerations to know whether there is income for tax purposes. First is the existence of income. A primary consideration in income taxation is that there must be an income before there could be income taxation. There must be a gain or profit, whether in cash or its equivalent. In the case of security advances and security deposits paid by a lessee to a lessor, the amount received by a lessor as a security advances or deposits is not considered income because it will eventually be returned to the lessee. Hence, the lessor did not earn, gain, or profit therefrom. Here are some of the examples of receipts not considered as income. First are assessments for corporate contributions. Next, increments resulting from revaluation of property. They should be recognized as unrealized income until the revalued property is disposed of. And money or property borrowed. Borrowed money has to be repaid by the debtor. On the other hand, the creditor does not receive any income upon payment because it is merely a return of capital. Second consideration in income taxation is the realization of income. Under the realization principle, revenue is generally recognized when both of the following conditions are met. First, the earning process is complete or virtually complete and an exchange has taken place. Take note that a mere increase in the value of property is not considered as income for tax purposes since it is an unrealized increase in capital. No income is derived or a loss incurred by the owner until after the actual sale or other disposition of the property in excess of its cost. On the other hand, increase in the net worth of a taxpayer is taxable if it is the result of the receipt of unreported or unexplainable tax income. However, if they are merely shown as a correction of errors in its entries in its books relating to its indebtedness to certain creditor, which had been erroneously overstated or listed as outstanding when they had in fact been duly paid, are not taxable. Lastly is the recognition of income. Income is considered received for Philippine income tax purposes if actually or physically received by taxpayer or if constructively received by taxpayer. Under the doctrine of constructive receipt of income, income which is credited to the account of and set apart for a taxpayer and which may be drawn by him at any time is subject to tax for the year during which it was credited or set apart, although not yet then actually received or reduced to his possession. To constitute receipt in such case, the income must be credited to the taxpayer without any substantial limitation or condition upon which payment is to be made. The doctrine of constructive receipt is designed to prevent the taxpayer using the cash basis from deferring or postponing the actual receipt of taxable income. Without the rule, the taxpayer can conveniently select the year in which he will report the income. Examples of income constructively received are as follows. 1. Matured interest coupons due and payable not yet collected by the taxpayer. Next, interest credited on savings bank deposit and distributable share or distributive share of the profits of a partner in a general co-partnership. That will be all for this video, guys. Please do share and subscribe to my channel for more tax lessons. And this is your virtual mentor signing off. Remember, do not just wait to be an inspiration. Be the inspiration. Keep safe, everyone.